The Great Depression is usually explained with a single image: the stock market crash of 1929, a sudden collapse, a dramatic fall, and an economy that simply fell apart overnight. But that story is incomplete because the crash was not the cause, it was only the trigger. Long before stocks collapsed, the American economy was already fragile. Growth during the 1920s looked impressive on the surface, but beneath it, deep structural problems were forming. Productivity was rising, but wages were not. Factories produced more than people could afford to buy. This imbalance created a dangerous illusion. Companies kept expanding, investors kept speculating, and households were pushed toward credit to maintain consumption. Debt quietly replaced income as the engine of growth. The financial system amplified this instability. Banks encouraged speculation. Loans were easy. Margin trading allowed investors to buy stocks with borrowed money. A small amount of cash controlled massive positions. This created an economy built not on savings, but on leverage. As long as prices rose, the system appeared strong, but it required constant confidence, and confidence is fragile. When stock prices finally began to fall, the leverage turned against the system. Margins were called. Loans had to be repaid. Forced selling accelerated the collapse. The crash of 1929 destroyed wealth, but more importantly, it destroyed trust. Banks stopped lending. Investors froze, and fear replaced optimism almost overnight. But the real disaster came after the crash. Instead of stabilizing the economy, policies made the situation worse. Interest rates were raised, liquidity was tightened, and credit disappeared when it was needed most. Thousands of banks failed. Savings vanished. Businesses collapsed not because they were inefficient, but because money stopped circulating. The economy entered a downward spiral. International policy mistakes deepened the crisis. Countries tried to protect themselves. Trade barriers were raised. Tariffs exploded. Global commerce slowed to a crawl. The gold standard turned recession into depression. Governments could not expand the money supply. They could not respond flexibly. Economic pain spread across borders, locked in place by rigid rules. Unemployment soared. Entire communities collapsed. The system that promised prosperity delivered insecurity instead. And for millions, the future disappeared. The Great Depression was not a natural disaster. It was not inevitable. It was the result of human decisions, flawed incentives, and systemic fragility. Eventually, governments changed course. Spending increased. Regulation returned. Confidence slowly rebuilt. But recovery was long and painful. What truly ended the Depression was not a single policy. It was a complete transformation of the economic system. New rules, new institutions, and a recognition that markets alone could not prevent collapse. The lesson of the Great Depression is uncomfortable. The system did not fail suddenly. It failed slowly, invisibly, while appearing successful. The crash was only the moment when reality could no longer be ignored. A signal, not a cause. And this pattern did not disappear. It repeated itself in different forms. Across decades, debt-fueled growth, asset bubbles, financial fragility. Each crisis echoes the same structure. The Great Depression teaches us that economic collapse is rarely caused by one event. It is built over years, hidden behind growth statistics and rising markets. When confidence breaks, the system reveals what it truly is: not stable, not self-correcting, but deeply dependent on trust. Understanding this matters, because history does not repeat itself exactly, but it often rhymes. Every generation believes it has fixed the past. Every system believes it is different, until it isn't. The Great Depression was not caused by panic alone. It was caused by structure, by incentives, by design, and as long as economies rely on debt-driven expansion, the same vulnerabilities remain. The crash was visible. The causes were invisible, and that is what made them dangerous. The real reason the Great Depression happened was not a single day in 1929. It was a decade of fragile growth built on unstable foundations.